Bitcoin ETFs did billions. They've already surpassed. If you just look at like the first month or the first 6 weeks, we're about week 7, I think. If you stack them up on any measurement, they blow everything away. At this point, you could probably find something in there like, if we look at the first 2 weeks and we X out GBTC technically, and we adjust for inflation, technically the GLD actually was tied. Like, there are ways to maybe find a spot in the 7 weeks where it wasn't earth shattering. But if you go 1 week, 1 day, 4 weeks, 6 weeks, 7 weeks, you look at volume, assets, flows, post GBTC, X, whatever you want to do, you're going to find they blow away every other new launch record. It's getting to the point now, and I just told you that I'm looking at the most ETFs traded. Right. This is out of 3,400. IBIT is 7th. This is right up there with SPY, QQQ, IWM. These things have been around for 25 years.
Right.
This thing's 7 weeks old. I've never seen an ETF go right up to the top 10 like that in this sort of a time. So, and I think GBTC is in the top 30. And Fidelity is 38. I mean, if you added them together, they'd probably be like the 4th biggest most traded. And if you're the 4th most traded ETF, it puts you around number 8 in terms of all equities. So if you combined all the trading in the Bitcoin ETFs, in fact, I'll do that right now, you're looking at something like, let's say we'll call it trading about as much as Apple.
Wow.
That's a lot, right? So this is volume, and I get it. Some coiners are like, you talk about the volume, but it doesn't necessarily mean the flows are the same. And I get that. Only a portion of volume converts into flows. But you have to understand that ETFs are trading vehicles, right, and volume is so important long-term, and it's important for bigger fish.
BlackRock's foray into Bitcoin ETFs amidst unprecedented demand is poised to propel Bitcoin's value to new heights. Currently, the Bitcoin ETF market is witnessing explosive growth, with top ETFs accumulating over $50 billion in assets within just 7 weeks, shattering all previous benchmarks. In contrast, gold ETFs are seeing a steady decline in interest. If the current trend persists, Bitcoin ETFs are expected to outpace gold-based ETFs by the coming summer, according to Balchunas. Recently, Balchunas shared insights on the potential for Vanguard to list Bitcoin ETFs, the institutional perspective on Bitcoin, and central banks' reactions to these new investment vehicles. He observed that although banks could potentially issue Bitcoin ETFs, many are opting to remain cautious, watching market volatility from the sidelines. Balchunas highlighted that Bitcoin ETFs cater not only to crypto enthusiasts but also to individuals seeking to diversify their portfolios with a touch of excitement while still managing risk. He advocates for a modest allocation, suggesting that even a 1% investment in Bitcoin ETFs could help investors mitigate pressure and avoid impulsive decisions in response to market swings. Stay tuned until the end of this discussion, where Balchunas will unveil the long-term implications of Bitcoin ETFs on Bitcoin's trajectory. Now let's delve into why Balchunas believes the true potential of Bitcoin ETFs is still vastly underestimated.
Let's face it, Bitcoin is a little like a rated R movie for most people, for normal people. Like, take your parents.
Right.
If Bitcoin were a movie, it'd be Quentin Tarantino. It would not be Disney, okay?
Sure.
Vanguard just does Disney. They don't do the crazy stuff. They don't allow leverage ETFs on their platform. They do allow gold, but they don't like it. They're a meat and potatoes kind of company, family-friendly, 60-40. And this, in my book on Bogle, I interviewed him many times, and I also asked him about Bitcoin, and he had nothing personal against it, although I do think the spirit of disintermediation is huge with him and Bitcoiners. There's a lot of overlap, which is why I asked Matt Hogan from Bitwise to write the foreword to that book, because he's an ETF guy who works heavily in crypto now, and I thought he could bridge the gap between the old fogey mutual fund world and Bogle and sort of connect him to the disintermediation movement that Bitcoin has, and I think he did a great job. But Bogle's problem with commodities was that it's only worth what someone will pay for it in the future. Whereas a stock is a company, and a company has people who go there every day, wake up, create value. That value turns into sales, which turns into cash flow, which turns into dividends to you. So even if the price does nothing and there's no speculation, you get paid. The money works for you. A bond, you get a interest rate, a coupon payment. So stocks and bonds, the money does work for you regardless of speculative return. He argued commodities are just pure speculative return. There is no underlying thing. Now, Bitcoiners will say, well, there are people creating value in Bitcoin. Fine. I'm not Bogle. I'm just telling you what he would say and what Vanguard thinks. And I think people inside Vanguard aren't happy about that decision. I think some might be, some might not. I personally think that it's a little nanny state-ish of them. They should just trust their own investors to make decisions. If you found Vanguard and you are a Vanguard person, because they don't pay intermediaries, so you had to find Vanguard. So if you found Vanguard, you're definitely into low cost and the Bogleism. You're probably not going to be the person who's swayed and going to put all their money in Bitcoin. That's just not who you are. So there's no harm, I think, in them putting it on their site. Whereas you could argue like putting big advertisements on Robinhood for the new Bitcoin ETFs could be a little risky because people are just going to go crazy there. So I just think they shouldn't have done it. And I do think they'll lighten up over time because they have an advisory service. So they don't only offer funds, they also will advise you on all your money, like your estate planning, your taxes. And if you're an advisor, you kind of need access to everything. So like if your client is like, hey, I actually want private equity or Bitcoin, you kind of have to get it for them. They're going to leave. So I think their move to become a bigger advisor is going to push them into offering Bitcoin at least. If not, they're probably not going to have a fund, maybe. Times change. But for now, I get why they did it. If my metaphor for this, somebody said, oh, this is their Bud Light moment. Like this is going to ruin them. And I'm like, no, because Bud Light really crapped on their own base's views. Right. Vanguard did not crap on their base's views. This is more like Walmart not letting the gangster rap albums in the late 80s on the shelf. You know, like Two Live Crew and NWA. These are my favorite albums as a kid because they had the parent advisory label on them. But Walmart wouldn't carry them, and it gave them more intrigue. So I actually think Vanguard saying no gave the story another news cycle. It created conflict and attention and intrigue. So I think, if anything, Bitcoin ETFs benefited from that. If you're an institution, say you're a hedge fund or a prop desk, a trading outfit, or a pension plan, and you want a little crypto Bitcoin exposure, you love the fact that you can put on a $100 million trade or a $50 million trade and no one will notice you. That's a big deal. If it doesn't trade a lot, I was like, I don't want to be half of the assets. I don't want to push the market price. I don't want a hedge fund to see a big fish coming in and try to game me. The more volume there is, the more anonymity these big fish can come in without anybody noticing them. They love that. And so they prioritize liquidity over everything else. So the volume is really good, even though it may get people hyped. Oh, it traded $1 billion. They think, oh, that's going to be $1 billion in assets. Doesn't quite work out like that. Yes. Some of it will be inflows, but the volume is like if you were fishing for professional institutional traders and they were actual fish in a lake, and you were tasking me what bait to use, I would tell you volume. More important than fees even. Advisors love fees and low fees, but these are already low. So I always tell people, if you want full maximum category growth, you need two things: low fees and high volume. And they got both already. So they're in great shape. That's why we track volume. Volume also, in my opinion, portends flows and assets later. Like, for example, in 2008, in the awful sell-off, a lot of institutions discovered ETFs for the first time because they were liquid when other things weren't. So let's say there's some kind of massive crash in the market and Bitcoin's kind of brought into that. And there's some illiquidity in the Bitcoin market. I guarantee you, IBIT and FBTC, these will be the most traded things that offer Bitcoin. So institutions are going to be like, I'd rather use the ETF than actually even interacting in the underlying currency. So that's how bond ETFs got big. And so 2008, bond ETFs saw volume spike up huge. And in the years after, their assets went up. Volume is a lot of times also when someone gets their first taste of an ETF, they're like, oh, that was it. I had a good experience. They come back later. It doesn't always translate immediately that night. So, but volume is, again, it's like measuring frequency or popularity. Over time, that volume does convert into assets. So to me, it's the leading indicator of a category's asset growth. You know, the guy who runs JP Morgan's ETF business, he said never say never. But he also said they're happy to sit this out. and just watch all the craziness. So I think what it means, though, is that if banks are allowed to handle Bitcoin, it means they can be part of the ecosystem more. And the reason they were interested to be part of the ecosystem after the launch was they were like, wow, this is bigger than I thought it was going to be. You have to understand, many people wrote this off. Even really smart people. There's this one guy who used to work at Morningstar who's like one of the smartest ETF analysts that you'll ever meet. He's into the crypto space now, actually. And his predictions were so low, and I was higher, but they like were 10 times higher than mine. And his was like way down here. So a lot of people just thought, this is all about nothing. All this approval watching, it's going to come out and it's going to be like, there'll be like a couple 100 million, but who's really the audience? Most of them, I think, underrated the power of the ETF.
Yeah.
Somebody the other day said, if you want to spend less money, stop shopping at Amazon and just go and get everything physically, because everything else, just the lack of friction makes you buy more.
Yeah.
That's the ETF. So the ETF is so good that you could put like dog shit in it and it would probably sell a little bit of dog shit.
Right.
I think Bitcoin obviously has a real market, and I say that facetiously. There have been ETFs that flop, no doubt, but the demand is probably even somewhat generated by the fact that it's now so convenient, easy. It's in a trusted wrapper,
Right.
SEC approved, and it's with these big brands that everybody knows and loves that have been around for like dozens of years. In Fidelity's case, like, I don't know, 100 years. So like, this is a big deal for professionals, conservative people, older people. Like I said, I think that the Bitcoin ETFs are not for crypto people. They're for their parents. But their parents have a trillion times more money than them. So I was actually looking at, there's $157 trillion in wealth in the United States. The boomers and the silver generation have like 102 trillion of the 157. So they have the vast majority of all the money. And so even if a tiny, tiny sliver of that is like, yeah, I heard my kids talking about it, or I don't want to kick myself in 10 years if this thing does go crazy, even if I don't understand it. That's a logical thought. And so I think that's what people underestimated, was buying the Bitcoin ETF as a way to have a little fun on top of your boring 60-40, and the potential future FOMO cure. People know themselves. They even though they love their 60-40 and their Vanguard, they also like sometimes see something happen and they're like, they don't want to miss out. And they think they feel with Bitcoin, I don't understand it, or I even think it's a scam, but I don't want to be like feeling like an asshole 20 years down the road when it's $1 million and I could have just put a little in my account. So I think like future FOMO cure is an underrated thing. And the other thing is the idea that there's way less pressure when you're talking about the hot sauce part of your portfolio for a boomer. They're not going all in. They'd put 1%. And like, okay, it flames out. This is not the money that counts. This isn't my beach house. This isn't my kids' money.
Right.
This is just a little flyer on something that just in case it goes up, So there's just a lot less pressure. And if something's volatile and speculative as Bitcoin is, the fact that it's only 1%, you can stomach that volatility much better than if it were the whole thing. And so I believe that Vanguard in the core has actually done wonders for people's behavior with the crazy stuff. Look at ARK. ARK was used as a 1% allocation.
Yeah.
Hardly saw any outflows when it went down 80%. In the old days, they would have seen all the people left. But because ARK was simply a little hot sauce add-on, people were like, yeah, okay, I get it. Kathy's stuff is volatile, but I still think she has a vision of the future that could come true. And plus, it's only 1%. Who cares? So people are less likely to act. That's why this thesis I see on Twitter about this, all traders and weak hands, I would think the opposite. I think the Bitcoin ETFs are going to be much stronger hands than people think. Not necessarily because the people are strong. It's that Vanguard and the core has made them strong. And that's all that's underappreciated. But again, as a guy who lived in this book and the other book, I feel somewhat trained to make this assessment. And when I talk to people and actually interact with them, anecdotally, that's what I hear. And then I look at the flows, and in these sell-offs, you just don't see money coming out of thematic ETFs or ARK ETFs. So the stuff that's used in the hot sauce bucket doesn't necessarily, people don't leave when there's a downturn. Some will, and IBIT in particular could be like the GLD, where it's traded so much, where you do have these institutions who are using it in all kinds of different ways. And the flows might be like this. But over net time, you probably see an increase. That's what's happened with GLD, with Treasury ETFs. But there will be one that gets, I think, more sensitive to price. But like a Fidelity one or some of the other ones that are long-term holders, I doubt you'll see people running for the hills in a sell-off. A little, but it's not like I just don't. That's my take. And so the strong hands theory is also part of why people underrated the growth or the asset potential, in my opinion. But I'll be honest, I even underrated it a little bit. Where we are now, I thought there'd be 10 to 15 billion in flows after the first year. So we're already at 6. So we're essentially halfway to where my middle point is. And it's only been 2 months. My prediction's probably dead in the water, but I'm happy to be low. I think we've been so optimistic on approval. We were optimistic on how these would be bigger than people think. Like, we've been largely bullish the whole time that I think we'll get a pass for being a little under bullish, but we weren't like haters bearish. 10 to 15 billion is a legit category starter. GLD was probably, I think GLD's first year was like $1.5 billion. So you can see why 10 to 15 is pretty optimistic, but the 6 billion I think is pretty shocking in the first 2 months, or it's not even been 2 months, 7 weeks.
Eric Balchunas shared his perspective on the remarkable expansion of Bitcoin ETFs and their influence on the investment world. As we delve into his insights, it becomes evident that Bitcoin ETFs are far more than a fleeting trend. They represent a meaningful enhancement to investment strategies, providing both thrill and solidity for investors from various walks of life. With Eric's expert analysis, we gain a deeper understanding of the forces propelling this unique market development and its potential impact on the financial sector's future. I hope you found today's video both enjoyable and informative. I look forward to seeing you in the next one. Until then, wishing you all the best.